gets, the Federal Reserve has to move interest rates above the inflation rate. So long as the Federal Reserve artificially suppresses interest rates by holding them below the rate of inflation, something that would never happen in a free market, but as long as this is Fed policy, it is stoking inflation's fires, not putting out the inflation. And again, it's not going to make any headway unless it has cooperation from the government. You can't have fiscal stimulus and fight inflation. You need contractionary fiscal policy married with contractionary monetary policy to reverse this process. And of course, none of it can be accomplished not only without a severe recession, but without triggering a worse financial crisis than the one that was experienced in 2008, which is why the Fed is not actually fighting inflation. Of course, it can't admit that, so it has to pretend that it's fighting inflation while it secretly continues to create more.
Recently, an inflation report by the US government has been released that shows some haunting figures. What does this report say? And what do the economists have to say on this? During the time when most economists were bewildered about the report, there was someone who was expecting this: Peter Schiff. Peter Schiff, the founder of Euro-Pacific Capital Incorporation, a chief economist, author, and analyst, have warned the Fed and people about high inflation. Even if the US President, Joe Biden, said he is optimistic about America's future, the reports say something else. And here's an interesting thing: the Fed can control inflation, but it will cause a financial crisis. But if it doesn't allow the crisis to come now, the future's collapse will be irreparable. Let's listen to what Peter Schiff has to say about the inflation report, the crisis status, and the market future. Believe us, things are really going dark at this point. Let's get started. What has the Fed been doing lately? Nobody knows the reality of every step that the Fed took. Everyone thinks the Fed is trying to control things and bring out the best for the people. However, the reality is quite the opposite. It appears that the Fed is doing the opposite of what it is supposed to. Lately, the Fed has been working like a political party, making popular but destructive decisions, instead of making unpopular but sound decisions. But what did it do? Well, Peter Schiff said the Fed is neither taking inflation under control nor increasing interest rates. Often, people criticize increases in interest rates. However, now it's the only solution to lessen the tensions exerted by high inflation. If interest rates are increased, people will get at least some leverage to buy products at these high inflated prices. However, if the interest rate is kept below the inflation rate, people will lose from both sides. Peter Schiff said that instead of allowing the free market to decide the interest rates, the Fed artificially brought them down. However, for inflation, it didn't do anything that should be appreciated. It's allowing inflation to rise while it's suppressing interest rates. Most people are unaware of the dire consequences it can bring. As long as this continues, the inflation fire will expand, and paying for necessities will become difficult with every passing day. Peter Schiff said that the government and Fed have to bring inflation down and interest rates to heights. This doesn't mean that inflation should come at zero, and the interest rates should be at 100% rise. Rather, the free market should decide inflation and interest rate percentages. At this point, when the Fed has been continuously interrupting the free market for decades, the situation has become quite delicate. No safe solution has been left, which the Fed can pick and balance things. Peter Schiff said that the government and Fed have to contract the fiscal and monetary policies to release the burden off the market. Here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. So why doesn't the Fed do it? Well, this isn't a simple decision. Peter Schiff said that contracting the fiscal and monetary policies will make the market collapse and financial crisis inevitable. However, the Fed has to allow the crisis to come now instead of allowing it to come in future with more destructive force. But why does Peter Schiff want the Fed to allow a crisis now? How a crisis is a good thing for the economy? Well, a crisis in itself isn't good for the economy. However, at this point, there isn't any other option. The Fed has been artificially preventing the crisis. How long will it do it? One day it has to allow the crisis to take over. Why not now, when things can be brought under control after the crisis, instead of when everything will be out of hand? Currently, the Fed is pretending to be working hard to bring things back to normal, but in reality, it's doing nothing other than further ruining the system. Preventing the crisis comes with a high cost, which is high inflation. Up to a certain point, the Fed can prevent crises by increasing inflation, and that's what it has been doing. The Fed is preventing the collapse today. However, it's allowing the pressure cooker to boil for the future. Listen to what Peter Schiff said.
On Friday, we got another worse than expected inflation report in the form of the November PPI. Now, one of the reasons you know the report was worse than expected was that the markets were all trading higher right before the report was released. Dow futures were up almost 200 points, and gold was trading up over $10, back over 1,800 an ounce. The US dollar was lower because everybody expected the dollar to be weaker and gold and the markets to be stronger once they received the good news that inflation was coming down. But once again, investors were disappointed by a hotter than expected report on inflation. And again, it makes no sense to me that so many people expect inflation to be coming down when nothing the Federal Reserve has done thus far is equal to the task. In fact, it's not just that what the Fed has done is inadequate to reduce inflation, but the U.S. government itself has done nothing to reduce inflation. In fact, everything they've done is throw gasoline on the inflation fire, because ever since inflation became an obvious problem that people were complaining about, the only response we've had from Washington is an increase in government spending, which just compounds the inflation problem. And as I've been discussing on this podcast, the Federal Reserve has been filling the pipeline with inflation for over 10 years. And it hasn't even turned off the spigot. All it's done is slow down the rate at which it pumps new inflation into that pipeline. In order to turn off the monetary spigots, the Federal Reserve has to move interest rates above the inflation rate. So long as the Federal Reserve artificially suppresses interest rates by holding them below the rate of inflation, something that would never happen in a free market, but as long as this is Fed policy, it is stoking inflation's fires, not putting out the inflation. And again, it's not going to make any headway unless it has cooperation from the government. You can't have fiscal stimulus and fight inflation. You need contractionary fiscal policy married with contractionary monetary policy to reverse this process. And of course, none of it can be accomplished not only without a severe recession, but without triggering a worse financial crisis than the one that was experienced in 2008, which is why the Fed is not actually fighting inflation. Of course, it can't admit that, so it has to pretend that it's fighting inflation while it secretly continues to create more.
But what shocking thing does the inflation report say? Well, the latest PPI report, or Producer Price Index report, shows higher than expected price increases in everyday goods prices. The Producer Price Index shows the rise in average selling prices over a period of time. Peter Schiff said that the expected increase in the Producer Price Index was 0.2%. However, the PPI report shows an increase of 0.3% just in 1 month. That's overwhelming. The year-over-year increase was expected to be 7.2%. However, the report showed an increase of 7.4%. And that's not the end. The expectations of price increases were already high, but the real report has surpassed even those high inflation expectations. Service prices increased by 0.4% compared to 0.1% in October 2022. The food prices increased by a massive 3.3% within a single month, hinting toward further hikes next year. Excluding the food and energy prices, the increase is 6.2%, which is more than triple the expected rise of only 2%. It appears that the Fed has at least calculated, but every indicator is pointing toward an increase in prices. The Fed forecast for every commodity was lower than the actual increase in selling prices, which isn't good. Peter Schiff said that the Fed is trying to show this way that inflation is being taken care of. But you can see the report and decide what the Fed is doing. The price decline of some commodities like energy isn't even permanent, so you cannot trust that inflation is coming down in 2023.
More. But turning to the PPI number itself, the expectation was for a 0.2% rise in November producer prices, and that would have matched the 0.2% from the prior month. Well, not only did the November number come out above estimates at 0.3, but then they went back and revised the October up 0.2 to up 0.3 as well. So in the way, the forecast was correct in that both November and October producer prices increased by the same amount, but it was wrong in that both months increased by 50% more than everybody expected. Now, the year-over-year number, which was expected to be 7.2 and a big drop from 8% from the prior year-over-year number, that did come down, but not as much as estimates. It came down to 7.4%, and that was actually above the consensus range, which went from 7.1 to 7.3. And if you take out food and energy, it was even a bigger miss. They were expecting an increase of 0.2. The real increase was 0.4, again, above the range of estimates, which went from 0.1 to 0.3. And adding insult to injury, they took the unchanged number that was reported in the previous month and they revised that up to an increase of 0.1. Again, looking at the year-over-year core, taking out food and energy, the expectation was for an increase of 5.9. Instead, the increase was 6.2, once again above the consensus forecast range, which went from a low of 4.8 to a high of 6.1. Even if you take out food, energy, and trade services, it was another beat. Instead of rising 0.2, which would have matched the previous month, it increased by 0.3, and the year-over-year gain was 4.9. But the bottom line on this inflation report card is that even though it may not be an F because it was a little bit lower than the prior month, it's still a D minus, and that's not a passing grade. Even though it's still below the year-over-year numbers from the prior month, you're still looking at 7.4% year-over-year increase in producer prices. And even if you strip out food and energy, you're still looking at 6.2%. That's more than triple the 2% target. It doesn't matter that it's not 8%. It's nowhere near 2%. There is no real progress being made, and there's zero evidence that any of the so-called progress that has been made is permanent. There is no proof that this is anything other than a temporary decline in an ongoing upward trend, meaning that the high year-over-year rates of inflation that we put in may well be eclipsed in the next run-up. Everything ebbs and flows, and that's all that's happening with inflation. There's going to be some relief. Every bull market has a correction, and we have a bull market in inflation. Inflation is going to keep going higher, even if temporarily we get a correction and the rate of increase declines. The annual rate of increase is still high, just not as high as it once was. A 7.4% year-over-year increase in producer prices is bad. Is it as bad as the high water mark, which I think was about 11%? No, it wasn't as horrific as that, but it's still a bad number, and we're still on a bad trajectory. And I think sometime in 2023, we're going to set a new high water mark for producer prices, particularly when the current recession ratchets up to a new gear, and that's likely going to be when we get the big increase in unemployment.
At this point, you need to understand what Peter Schiff wants you to know. You might be seeing more reports coming from the Fed and government that might highlight how good the government has been doing. But you should understand that these reports only focus on what's temporary. The reports will show how good this month is compared to the last, but you should compare it to last year. Nobody, not even the Fed or the president himself, assures people that the upward movement will be permanent. They cannot promise that inflation will come down, because they are the people who have to decide to increase inflation in the first place. As Peter Schiff said above, the Fed is increasing inflation and not increasing interest rates because that's how the crisis can be prevented. But people need to ask this: how long will the Fed prevent something doomed to fall? Peter Schiff said that now, people shouldn't be surprised to see high inflation and high inflation reports because that will be the new norm. Did you know that the Fed could lessen inflation but isn't doing so? Do you think Joe Biden might be the one asking the Fed to prevent a financial crisis during his government? Comment right below in the comment section. Do you agree with Peter Schiff that a worse era of inflation is yet to be unfolded? Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.